Good evening and welcome to the ShadowTrader video weekly for Sunday, May 18th, 2008. This weekend's video is going to be about why I think that it's not really the right time to get into new longs here, but rather to give it a little bit of pause. The market is acting pretty bullish, but it has come up to our near-term target here, which is the 200 period moving average on the daily of the S&P and also of the Dow. If you look at the Dow, it's showing a little bit of relative weakness as it has not made a new swing high over the early May highs, but the S&P has. The NASDAQ, which I don't talk about that much, but I will here, is showing relative strength in that it's already broken through the 200 MA. But remember, these 200 MAs can act as magnets and hold prices around them for quite a while. The NDX is, of course, the clear leader as tech seems to have ignited a bit and has cleared the 200 by a bit. But our main concern here is the broad market, the S&P, which is continues to be our focus. So as I said earlier, from a kind of a top-down perspective, I want to talk about why I think this is not the time really to get into new longs, but rather to just pause a bit and wait it out and see what the market does here for at least a few days to a week. One, we've moved up into the resistance area. Secondly, the market's already been up here about 5 days in a row off of the trend line support, right, moving into the resistance area. The next thing is the internal picture under the hood, which to me seems to be slightly weakening. You can see here, if I bring over the S&P chart that has the breadth on it, bring this over to here. This is the one I use to show you the relationship between the prices and the breadth ratio here, which at 50 is parity and anything above is positive, meaning that there's more up volume than down volume. You can see here that there was kind of a triple top in the breadth as the market moved higher. This would be what we call negative divergence, meaning that the up-down volume ratio that's happening under the hood should be, pushing at new highs as the market moves higher. And the biggest disappointment really wasn't these three peaks here. It was really here on Friday specifically, as the market, if you look at the spider here, it's clearer on the daily, actually made new highs, right? But you can see that we closed on the breadth here at parity, right? The market kind of rebounded late day. It was an options expiry day, which I will admit kind of can make things kind of squirrely. So that definitely is a caveat that could throw a wrench into my analysis here. But either way, I don't like to see the market make new highs and the breadth doesn't. Now, one of the reasons that, well, actually, and before I get off that, I want to stay on the internals, and I'll talk about the AD line here, which has been basically similar. The advanced decline line, I'll move that across, on Friday was a similar situation where you basically closed at here just over 100, right? This is advancers minus decliners, and the move from the lows was from minus 660. 700 up is not that much of a move. If it's a really, really strong move, you can see like 1,000 to 1,500. Like look here on Thursday, this was from minus 500 to plus 1,100. That's a really strong move. But these 700 ticks is, somewhat strong, but it's not that major. And for us to close at 102 when the market actually made a slight new high that day, to me is just slightly bearish. Now the reason why this is happening is very simple. Is because the market is basically stuck right now in what we call like narrow leadership or a narrow rally. It's not a broad-based rally because the financials refuse to participate, and the financials are such a big piece of the S&P. This is the core sector list from Friday, okay? Now look how much red there is here, yet the market's closed. The Dow was down 5, the S&P was up 1, right? And again, we did make highs in the spider that day over Thursday's highs, right? So forget the fact that the market here, right, closed equal. What matters is that in the context of the rally in these 5 days up, on the last day when we pushed a little bit higher, I'm trying to show you that, in my opinion, the people who bought on Friday, initiating new longs, right, thinking that the market's going to just keep going and going, okay, that it feels to me like they'll be dumping them quickly early next week as somewhat of a pullback should occur. Or if it does, they will be the ones panicking out first, because it's kind of a situation of like, last in, first out, because they're going to be what we call the bag holders, the quote-unquote late to the party Charlies, right? Okay, so that's the situation with the core sector list. And again, you want to look at which sectors specifically are lagging constantly and which ones are leading, excuse me. And it's just the same situation that we've been seeing for a while, where this sector, broker-dealer, right, and this sector, banking, are just crap and they can't seem to move. And these sectors, oil services and oils, are constantly on top and they're constantly moving. So in any pullback situation, this is probably where you want to be, which is pretty obvious. Right now, let's look at some of these sectors more in detail so that we can get a good grip on where we want to be, you know, if a pullback situation occurs. Let's look at the XOY first. And again, going deeper from a top-down analysis into the sectors now is yet another confirmation to me of why this is the wrong time to be getting in. Oils, if you missed it, you missed it. I mean, does this look like a chart that has any type of pivot to you where it's like, okay, now I'm going to be buying? No, I mean, obviously there was a buy point somewhere here, a buy point somewhere here, and when the train left the station this long ago, there's nothing really here. To me, it's just a wait for a pullback. Now, this doesn't mean in any way, shape, or form that you should be shorting it, because that's really a kind of an amateurish mistake. You don't want to short strong sectors, because generally what they'll do is sometimes they never come down, and sometimes they just go sideways like here and then go back up. And as they're going sideways, you may think for a short while that your short position is working, and then you're forced to cover, and then we go higher, which is actually what fuels the move up. OSX, same thing. It's just not the time